Investing can be a challenging journey, and even the most experienced investors, such as Warren Buffett, sometimes make mistakes. In this guide, we review 12 common mistakes that investors often make. Each section below is dedicated to one specific mistake, explaining it in simple language so that you can understand what to avoid. By learning these lessons, you will be better prepared to make thoughtful decisions with your money. Remember that successful investing is not about following trends or reacting to short-term market movements. It is about patience, discipline, and a deep understanding of the businesses in which you invest. As you read through each section, consider how these mistakes might apply to your own strategies. And remember to like and subscribe if you enjoy learning about smart investing strategies. This breakdown will help you avoid common pitfalls and build a strong investment portfolio for a more secure financial future. Number 1. Following the crowd. Many investors make the error of imitating what everyone else is doing without stopping to evaluate a stock's true value. When a stock rises or falls, people often rush to buy or sell. This herd mentality can lead to poor decisions and missed opportunities. Instead of following the crowd, it is better to step back, study the company's fundamentals, and form your own opinion. By doing so, you avoid market hype and make choices based on careful analysis rather than emotion. This simple rule always helps you invest wisely, consistently. Number 2. Reacting to daily price changes. Many investors let daily fluctuations control their decisions rather than focus on long-term performance. They become emotional when prices rise or fall, often selling in panic or buying in excitement. This reaction stops you from seeing a business's true potential. Focus on the company's fundamentals and future growth instead. Stock prices change constantly due to factors that do not affect a company's real value. By staying calm and avoiding impulsive moves, you allow your investment time to mature and gain compound returns, leading to a stable financial outcome. This steady approach creates long-lasting wealth. Number 3. Focusing on short-term trends instead of long-term growth. Some investors simply focus on market trends instead of considering how a company will perform over time. They buy stocks based on recent price spikes or sell after short-term drops, missing the bigger picture. This short-term focus can lead to hasty decisions that hurt portfolio performance. A wise investor looks at long-term growth potential, understanding that quality companies deliver steady returns. Concentrate on future earnings, management quality, and competitive advantages. By ignoring fleeting trends, you allow your investments to grow steadily and benefit from the power of compounding over time. Number 4. Investing every day instead of waiting for good opportunities. Some investors believe that they must invest every single day to succeed. They try to time the market continuously, hoping to catch every potential opportunity. However, this frequent trading often leads to mistakes and unnecessary losses. Instead, it is wiser to wait for the right opportunity when a quality investment becomes available. By being patient, you can avoid the stress of constant trading and focus on finding investments with strong fundamentals and long-term growth prospects. A careful, selective approach often yields better results than daily, impulsive buying and selling. Number 5. Over-diversification or not focusing on what you know. Investors sometimes spread their money across too many stocks in an attempt to reduce risk. While diversification can protect against individual losses, it may also dilute your focus and understanding. Instead of owning a vast number of shares, concentrate on a few companies that you understand well. This approach lets you deeply analyze the business, its management, and its competitive position. By keeping your portfolio focused, you can make more informed decisions and avoid being overwhelmed by too much information. Remember, knowing your investments thoroughly is key to long-term success. Number 6. Misunderstanding market timing. Trying to predict the moment to buy or sell stocks is a common mistake. Many investors attempt to time the market, hoping to capitalize on upswings or downturns. However, market timing is extremely difficult due to the unpredictable nature of economic events and trends. Instead of attempting to time the market, focus on the intrinsic value of your investments and hold them for the long term. Recognize that stock prices move for many reasons, and no one can accurately predict every change. A disciplined strategy that ignores short-term fluctuations usually leads to better overall returns. Number 7. Using too much leverage. Many investors use borrowed money to increase their investments, thinking it will boost their gains. However, excessive leverage can magnify losses when the market moves against you. Borrowing too much exposes you to higher risks, such as margin calls and fees, which can erode your profits. Instead of relying on leverage, focus on building your portfolio with solid, well-researched investments. A cautious approach that avoids heavy borrowing helps ensure that you are investing within your means. By limiting leverage, you reduce the potential for devastating financial setbacks and create a more secure investment strategy. Number 8. Over-focusing on minor details instead of the big picture. Investors sometimes get lost in the minutiae of stock performance, focusing on every detail instead of the overall business. They carefully analyze minor fluctuations in news, yet neglect a company's long-term prospects. This obsession with small details can distract you from really key factors like management quality, industry position, and growth potential. A broader view consistently focusing on fundamental factors leads to wiser decisions. By stepping back and viewing the big picture, you can avoid micromanaging your investments and build a portfolio that grows over time, ensuring long-term success. Number 9. Sticking to a stock due to purchase price. Investors hold on to a stock because they paid a certain price for it, even when the business no longer looks promising. This attachment to the purchase price can prevent you from making rational decisions. Instead of clinging to past costs, evaluate the company's current performance and future prospects. Selling or buying more should be based on the quality of the business, not on what you paid earlier. By letting go of ties to price, you can better adjust your portfolio to reflect a company's real value and growth potential. Number 10. Over-reliance on aggressive growth predictions. Some investors chase stocks promising rapid growth, drawn in by bold forecasts. This often leads to buying overvalued stocks that later underperform. Instead, invest in companies with steady, realistic growth and proven records. Focus on careful analysis over wild predictions to build a stable, gradually growing portfolio. Number 11. Letting market predictions drive your decisions. Some investors let forecasts and expert opinions drive their decisions instead of looking at a company's true fundamentals. This approach can lead to impulsive choices that miss the business's actual value. Instead, invest based on careful research and long-term data. Number 12. Ignoring continuous learning and open-mindedness. Many investors believe they know enough after early success and stop seeking new information. However, markets change, and relying on outdated strategies can be risky. Staying curious and continuously learning helps you adapt and improve your investment approach. Understanding these mistakes can improve your investing strategy. Successful investing requires patience, careful analysis, and ongoing learning. With a focus on long-term growth and continuous improvement, you can build a stable, secure portfolio.